In 1975, a man named John Bogle launched the first retail index fund. At the time, the financial establishment mocked it as Bogle's folly. The chairman of Fidelity famously remarked that he couldn't believe the great mass of investors would be satisfied with receiving just average returns. But there is a profound paradox at the heart of the global markets. In the pursuit of above-average returns, the vast majority of professionals, armed with supercomputers, insider access, and PhDs in quantitative finance, fail to beat the market over the long term. Imagine a room full of the world's most elite sprinters. They are all wearing weighted vests. Now imagine a person in the back of the room, standing still on a motorized walkway that moves at a steady, brisk pace. The sprinters are sweating, straining, and occasionally tripping over each other to get ahead. The person on the walkway simply stands there. By the end of the hour, the person on the walkway has outpaced 90% of the sprinters. This isn't just a metaphor. It is the statistical reality of passive versus active management. By the end of this deep dive, you will understand why three specific broad market instruments represent the pinnacle of investment efficiency. We are going to dismantle the three-fund portfolio, not as a beginner's shortcut, but as a sophisticated application of modern portfolio theory. We will explore why simplicity is actually the most complex thing to achieve in a world designed to sell you noise. To understand the three-fund portfolio, we must first define what we are actually buying when we buy the market. We aren't just betting on companies, we are capturing the equity risk premium. Think of the global economy as a massive, interconnected engine. Every time a person buys a coffee in London, a software subscription in San Francisco, or a lithium battery in Shenzhen, that engine generates a tiny bit of surplus value. As an investor, you have two ways to interact with this engine. You can be a lender or an owner. First, the total U.S. stock market index. This is ownership. When you buy this fund, you aren't just buying Apple or Amazon. You're buying the collective productive capacity of the United States. You own the giant corporations, yes, but you also own the mid-sized manufacturing plants and the small tech startups that just went public. Second, the total international stock market index. This is your hedge against home country bias. While the U.S. has dominated the last decade, economic history is a graveyard of former empires. By owning international stocks, you are capturing the growth of emerging middle classes in India and the industrial precision of Germany. Third, the total bond market index. This is the lender portion. You are the bank. You are lending money to the U.S. government and high-quality corporations. Why? Because while stocks provide the engine for growth, bonds provide the brakes. The magic happens through mean reversion. Assets don't go up forever. When stocks crash, the collective panic drives investors toward the safety of bonds. This inverse relationship, or low correlation, is the structural foundation of your wealth. By holding these three specific buckets, you are essentially creating a self-healing organism that thrives on the very volatility that kills individual stocks. Let's go under the hood. Why only 3 funds? Why not 5 or 10? To answer this, we have to look at the capital asset pricing model and the concept of unsystematic risk. When you buy a single stock, say Tesla, you are taking 2 types of risk. The first is market risk, the risk that the whole economy tanks. You get paid for taking this risk. It's the price of admission. The second is idiosyncratic risk, the risk that a CEO says something reckless on social media or a factory burns down. Here is the secret the industry won't tell you. The market does not reward you for taking idiosyncratic risk. Why? Because you could have easily diversified it away. The 3-fund portfolio is the ultimate idiosyncratic risk killer. By owning every publicly traded company, you reduce your specific risk to 0. You are left with pure, unadulterated market risk. Now let's look at the institutional players. Why do hedge funds hate this model? Because it exposes the alpha illusion. Most high-fee funds are just closet indexers. They charge you 2% of your wealth every year to essentially track the S&P 500 while making a few lucky guesses. In a 3-fund portfolio, your expense ratio, the cost to run the fund, is often as low as 0.03%. Imagine 2 pilots flying from New York to London. Pilot A takes a direct route and charges $5. Pilot B takes a zigzag route, performs 3 loop-de-loops and charges $2,000. They both land at the same time. The 3-fund portfolio is Pilot A. The hidden engine here is compounding costs. Over a 30-year career, a 1% fee doesn't just take 1% of your money. It can take up to 30% of your final nest egg. because that money wasn't there to grow. By using three ultra-low-cost funds, you are effectively performing a legal arbitrage on the financial services industry. You are keeping the surplus value that usually goes to the guy in the expensive suit on Wall Street. To see this in action, we have to look at two distinct eras: the lost decade of the early 2000s and the 2022 inflationary shock. On January 1st, 2000, the US stock market was the king of the world. Tech was booming. If you had put all your money into a US S&P 500 index fund, 10 years later, your return would have been roughly negative 9%. It was a lost decade for US equities. However, the three-fund investor didn't suffer this fate. Why? Because while US stocks were flat, international stocks had a massive run-up. Furthermore, the 2008 financial crisis triggered a flight to quality, causing bond prices to spike as interest rates were slashed to zero. The three-fund investor who rebalanced, meaning they sold their winning bonds to buy cheap stocks during the crash, emerged from the lost decade with their capital intact and a portfolio primed for the 2000s bull market. This proves that diversification is the only free lunch in finance. Fast forward to 2022. It was a brutal year because both stocks and bonds fell simultaneously. Many critics said, the three-fund portfolio is dead. But let's look at the mechanics. Inflation spiked, and the Federal Reserve raised rates at the fastest pace in 40 years. When interest rates rise, the price of existing bonds falls. This is simple math. However, the lesson here is reinvestment risk. As the three-fund investor's bond fund lost paper value, the underlying bonds were maturing and being replaced by new bonds paying 4 or 5% instead of 1%. By holding the total bond market, the investor was automatically upgrading their income stream. Within 18 months, the bond portion of the portfolio began to act as a massive tailwind. The system didn't break, it recalibrated. When you adopt the three-fund portfolio, you're making a profound macroeconomic bet. You are betting on the continued ingenuity of the human race. You are betting that, in aggregate, corporations will continue to seek profit, engineers will continue to innovate, and governments will continue to pay their debts to maintain the global financial system. If the three-fund portfolio fails permanently, it means the global economy has collapsed to a point where money itself has lost meaning. In any scenario short of a total civilizational reset, this portfolio wins because it captures the mean growth of capitalism. In an era of high-frequency trading, AI-driven crypto scams, and 24-hour financial news cycles designed to keep you in a state of constant anxiety, the three-fund portfolio is an act of rebellion. It is the realization that you do not need to be smarter than the market. You simply need to be more disciplined than your neighbor. So ask yourself, are you trying to find the needle in the haystack? Or are you ready to just buy the whole haystack and go back to living your life? The math is clear. The history is written. The only thing left is the patience to let it work.